Good afternoon, everyone. This is Bruce Kirsch, founder and CEO of Real Estate Financial Modeling. We are very pleased to have a terrific webinar for you today. This is the Fall 2016 Linneman Associates Capital Markets webinar. This webinar series has been going on for several years, and we are co-hosting it as Linneman Associates and Valuate Software, which is a product of Real Estate Financial Modeling. Everybody knows Peter. Just a very quick background on REFM. We provide financial analysis tools and training to commercial real estate business, and we have clients nationwide. And Linneman Associates, for those of you who do not know, is a strategic and financial investment analysis advisory firm founded by Dr. Peter Liniment. Okay, we are using the GoToWebinar platform, and I just want to address a couple of housekeeping items just to make sure that everybody's comfortable, and then we'll go ahead and get started. So on the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that is by design, and it will remain the case throughout the webinar. Please, if you can, take just a moment to familiarize yourself with a small floating control panel box which will be on the right-hand side of your screen. We will be showing the slides in the larger viewer window, which is on the left-hand side of the screen, but if you would like to download the slides, go ahead and find the handout section of that control panel box and click on the file name and it will download. You don't need to have the slides up while we do the presentation because they will show in the viewer window, but they are there for your reference and for keeping. We have reserved 15 to 20 minutes at the end of the presentation to answer participant questions, but please do feel free to submit your questions at any time during the presentation by clicking in the questions field of the control panel box, typing the question in, and just be sure to click the send button so that the question transmits to us. If at any point during the webinar you get disconnected, simply go back to the email where you clicked the link originally and you will be reconnected. And without any further ado, I'd like to introduce Dr. Peter Linneman, CEO of Linneman Associates. Peter, it's over to you.
Bruce, thank you very much. One thing you left out of your introduction of yourself is you're a former student of mine, a very good former student of mine, and a friend for a number of years. You've been very helpful on the book and a number of other things. So I appreciate your participating in this and all your support and help over the years. So Bruce, if we go to the first chart, which says cumulative percent increase in real GDP, what this does is track the increase in GDP for the 7 post-war recessions, post-World War II recessions, just so you can see how GDP did over time. You'll notice that this recovery is at the bottom. It's the blue line at the bottom, and it has lagged all the previous recoveries in GDP. That's the first message, is it's been a long, slow recovery. Very slow, very not robust, and that's unusual because normally the deeper the recession, the more strength there is in the recovery. Second, you'll notice that these recoveries don't all turn down at the same number of quarters. It's not like recoveries have a lifespan that is defined by time. So you'll notice that 2 of the recoveries marked in red had already started downward by this point in their recovery. But on the other hand, you'll see 3 of the others are moving up still very, very smartly at this point in the recovery. So the notion that this is an old recovery doesn't really hold much relevance. I think we'll touch on some things I do think are relevant. Go to the next. It says economic policy uncertainty. This is an index. Researchers found that when economic policies are well understood and stable, that is, the rules of the game are pretty well known, there's higher growth, and when they're not stable, that is, there's a lot of uncertainty, growth is lower. The red line shows the average. The blue is where we're at. You can see we went through a prolonged period of low political uncertainty in the 90s, and the economy did very nicely coming out of a recession then. We had a lot of uncertainty around 9/11, then we had low uncertainty in the mid-2000s, had high growth, and then we had this abnormal period of prolonged uncertainty, which relates to that long period of slow growth as opposed to robust growth. If you don't know the rules of the game, it's very difficult. We've kind of normalized in the last 2 years, although with a lot of volatility as we approach the election. You see the spike, and that's not surprising that as you approach the election. This data is not updated to include post-election, but this is going to be high for a month or two until you have a sense of who's on board, what's being done, what are the priorities, and so forth. On the other hand, the fact that we're down from this very high period of uncertainty is good for the economy. Go to the next chart. Shows real GDP year over year as a percentage growth. And you can see that we've had a sustained period of GDP growth averaging 1.5 to 2.3% per annum. Adequate, but not great. Well below its historic norm. I'm going to show you that in a different way. It's the same picture. You also see how steep the decline was during the recession. 2009 and 10 was a very deep recession, big drop in GDP. Go to the next chart. And I mentioned that we're getting 1.5 to 2.2% annualized growth. The long-term historic norm is closer to 3%, which is comprised of roughly 2% productivity growth a year of those already here, and about 90 basis points of population growth. You'll see the long-term trend I have on this chart is derived from 1969 to 2007. However, I've done a similar chart back to 1800. It doesn't look very different. The numbers are a little different, but it's the same picture. And that is blue, which is actual real GDP. And when I say real, all I'm talking about is adjusting for inflation. Real GDP is at an all-time high. It's risen from its drop. It's actually higher on a per capita and per household basis than it's ever been. So in that sense, the economy is doing better than it's ever done. But the malaise, the feeling of something's wrong, is there's a $3 trillion gap on about a $19 trillion economy. There's a $3 trillion gap between where we are and where we should be. It's a little bit like if you're on an expressway and you're used to going 65, 75 miles an hour, and traffic is only letting you go at maybe 40 miles an hour. It's not that 40 miles an hour is not moving along, and it's not that it's not moving along at a decent pace, but it's so much slower than you understand it should be. And this is like $6,000, $7,000 per person that this gap amounts to. This is a very significant matter. This gap, about half of it, is related to the very sluggish and abnormally slow recovery in the housing sector, particularly the single-family housing sector, which, by the way, is an employer of a lot of middle-class workers. Think of title insurance, think of construction, think of mortgage processing. So I'm going to come back to that this gap is largely due to housing and related activities. And so it raises the question of why has housing been so slow? Because if you understand why single-family housing is so slow, I think you have a better grasp of where we are and what's needed to have a more robust and continuing recovery. Go to the next chart. All it does is show actual versus trend. And those two numbers, those two lines you saw in the previous graph, but what it does is express it as a percent of GDP rather than an absolute number. And you can see we've been above trend, we've been below trend. I've taken this back to 1800. There have been times when we are well above trend for a while. There are times when we're well below trend, but we've always reversed the trend historically. Now, maybe this is the first time we don't. The Great Depression was a deviation, and it closed its deviation in about 4 years once it began reversing. And of course, during the Great Depression, people thought it would never reverse. Right now, it's about 14% of GDP, though, is this gap. And my belief is that a lot of regulations, a lot of market interventions, a lot of distortions, and a Fed that has set interest rates artificially at zero that has killed the economy. Low prices set by government away from market do not encourage economic activity. So, for example, we have about $2.1 trillion excess cash being held versus long-term trend, because at a zero interest rate, there's no opportunity cost to holding cash. And people are not going to invest in a 10% risk investment for a 4% return. So they sit on cash. Cash does not create a lot of jobs. Cash does not create a lot of GDP growth. And in fact, if you took the $2.1 trillion excess cash versus trend, that occurs exactly as interest rates plunge. It's not, in fact, the plunge in the growth in excess cash is almost exactly in line with what you would predict would have happened if interest rates were that low that long. This excess cash amounts to about 90 basis points of GDP being lost if instead this was invested at an 8% rate of return. So instead of sitting on all this excess cash, if we put it to use at an 8% return, it would generate about 90 basis points of GDP today. And this number is growing over time. So I think that the notion of low interest rates, and interest rate's just a price. If you set price artificially at zero, what happens? What happens is a lot of people want it, but at that price are not worthy of it. Hence, lenders saying, I can't find good loans, can't find good borrowers. That's because there's a lot of people borrow, but who's a good borrower if the interest rate is at nothing? And the second part of it is, if you believe low interest rates are a good thing, set by government, set oil prices to zero, set car prices to zero, set steel prices to zero, and set all the rents in the economy to zero to stimulate demand. Well, that'd be crazy. You don't stimulate demand by artificially putting prices low. You let markets have some general direction of figuring out supply equal demand. If you set prices to zero, you have a lot of people want it, but nobody wants to produce it. And that's kind of what's happened, is we're sitting on a lot of cash. A lot of people want that cash, but nobody's willing to provide that cash, and it's creating this gap. Go to the next. Get a quick couple of looks at the employment market, the labor market. You see the unemployment rate for youth, including part-time workers, it skyrocketed during the recession. It's come down pretty much in line with norm at this point. You see the overall unemployment rate down at 4.9%. It's gotten lower, but it looks fairly healthy. Labor market is not perfect. It looks pretty good. Go to the next chart. Another is the employment to population ratio. The population is defined as working age population. You saw what used to be low before women were a dominant force in the labor market. As women entered the labor market, it rose. As the baby boomers aged, it rose. And then it plummeted during the recession. Absolutely plummeted during the recession. You can see that over the last 4 years, it's crawled back up. It's still pretty low. By the way, part of the reason it's low is millennials are still in their high school and college and other types of training years. So a lot of them are not in the labor market. The millennials are a big population group. So that's pulling it down. But also, there's still a lot of people sitting on the bench. In particular, there's a lot of people sitting on the bench that are in their 50s and early 60s who, when the bad times happened, they declared themselves disabled, they qualify for disability, and while they don't live well, they live well enough for them. Those people probably aren't going to come off the bench. So this is going to stay low for a while, but as the millennials come back and the recovery continues, this will rise. Go to the next chart, another view of the labor market. Weekly unemployment insurance claims. This is a very real-time and very accurate number. The red is the average. Basically, when it's below 300, it's a good labor market, 300,000. You can see we're down in the 250,000 a week level. It's quite strong. You can watch this every week. I tweet about it every week. When it rises, and rises very rapidly for like 3 months, be concerned. But right now, this also says the labor market looks quite good. It's consistent with real wages rising. Go to the next chart, another look at the labor market. What percent of the unemployed are unemployed less than 5 weeks relative to the ratio that are unemployed longer than 26. It's the ratio of transitional unemployment to long-term unemployment. You would like to see this high. That is, lots of transitional unemployment, very little long-term unemployment. You can see that it plummeted. It's coming back. The duration of the unemployment is falling, but it's still not back to normal. The market still has a lot of people collecting out there. Let's go to the next and change. Where is the capital market? You have 10-year Treasury and the Fed funds rate. And what has happened is, yes, the 10-year Treasury has risen about 70 basis points, 60 basis points to 2.2. The amazing thing is after 60 basis point rise, it's only 2.2. By any normal standard, it should be in the 4.2 to 4.5 range. It's been artificially distorted down by the Fed, both by manipulating the short rate on a sustained basis and by their purchases and continued purchases of obligations and keeping that market that way. At this interest rate, there's just no penalty to holding cash. Hence, you have the large excess cash holdings. This has got to end. I think it actually will be one of the things that you'll see with a Trump presidency is there'll be very different types of people appointed to the Fed. I would look for people who believe more so in markets than market manipulation. This has been a very long-term market manipulation. If you look at the blue, you'll see the Fed has intervened and manipulated the short-term rate before, but for relatively short periods of time. This has been now 8 years. That's not a short period of time. And the Fed has created a new norm. I think as new positions open up, you'll see people more like John Taylor or John Cochran or people who, like me, have been saying for 7 years, okay, already you manipulated it for 6 months or a year, let the market go back up to its own level. Go to the next chart. The income, this is adjusted for inflation, the income that's derived in the U.S. from interest payments. Total debt in the economy is essentially the same as it was at the peak in 2007, and yet interest payments have fallen, or another way of saying it, interest receipts have fallen, so that these savers have been robbed of the difference between what normal interest rates would generate on that stack of debt and what these suppressed interest rates are generating. They've lost about $2.2 trillion in interest payments. And you ask yourself, what would you have done with $2.2 trillion as a saver? Those savers would have put that money to work. And some of that money would have gone to work in down payments. And in particular, some of that money would have gone to work by retirees with $400,000 to $800,000 of lifetime savings who have had no interest income on their 6-month to 2-year CDs, which are how real people save. If they have that kind of wealth, they've had no income for 8 years. so that when their daughter or granddaughter asks, can you help me on the down payment on my home, they say no. On the other hand, if they have $600,000 in CDs that are generating 4%, they have $24,000 a year that's coming in, and they feel pretty comfortable saying, yeah, I'll help you out. This has crushed the single-family market. Single-family, all the research that I've done and others have done is the single-family market is about, do you have the down payment, not do you have the monthly. And in fact, as you know, many people are making the monthly in rent right now. This has been a crushing part of the economy. Go to the next. Real household net worth is at a new high, even if you, whether it includes home equity or doesn't include home equity, it's at an all-time high. The best we can analyze, however, is the median is still below normal. So if the average is above normal but the median is below, it says the upper end has benefited. It's even stronger than that. The bottom third had nothing to lose. So they really lost nothing during the recession in terms of wealth. Think of yourself coming out of college. You had no wealth. You had nothing to lose when values fell. You may not have recovered anything, but you had nothing to start with. The upper end has recovered nicely, and the people who rely on 6-month to 2-year CDs have gotten crushed. They have not seen a rebound in their wealth because instead of getting income that builds on their wealth and rolls over, they've had nothing. Go to the next chart. It's housing starts and auto sales normalized to an index in 1967, so you can see them. And you'll see that the housing starts and auto move quite coincident through time, the red and the blue. You will see that this drop, the blue, was enormous compared to the drop in red. That's because it's a big ticket item. It's a very big ticket item. You need a down payment. The blue is bounced back, but much more sluggishly. And instead of becoming coincident again with the autos, it lags. This will continue to creep forward until people get some interest on their income on a sustained basis, on their wealth, and some of that then goes into down payments. By the way, you might notice in 2009, you see the spike in the red, and then it goes right back down. That's cash for clunkers. That certainly worked. That was a great market intervention. Go to the next. You'll see the household debt service ratio. This is household debt as a percent of GDP. There's other ways to measure it. You'll see the consumer loan, a consumer debt, as well as mortgage on top of it. The consumer has a lot of cushion by historic standards in terms of where their debt service is at, which means the interest rates could rise and they would still be quite comfortable. This is a good sign in that it says you can raise interest rates without crushing the consumer. Go to the next. Talking about the consumer confidence index, the red is average. You can see we're about average, slightly above average, but not much above average. I think that's a good sign. There are not real excesses in auto. There are not real excesses in single-family housing. There are little pockets of excess in commercial real estate, but they're pockets instead of everywhere. Absent excesses, you generally do not get a recession. So until you get these periods, you'll see some of these periods where confidence was very high. And I say when everybody believes they can afford a Maserati and buys one, it's really good while they're buying, and then it turns out very bad when you realize they couldn't afford it. That's the down. We're kind of very cautious still. So good, but and I think this continues then for another 2-3 years. Go to the next. You see federal government receipts as a percent of GDP in the blue, federal government outlays in the red, and then the difference, the deficit as a percent of GDP in the green. What you can see is that the expenditures were brought in. They were done in a very brute force way because Congress could not come to an agreement, but they have come down, They're now kind of a little above average. And revenues rebounded as the economy rebounded. People got jobs again. Capital gains were paid again. The deficit itself is running about almost 4% of GDP, little higher than sustainable mathematically. By the way, you're seeing Congressional Budget Office forecasts that, quote, with the Trump budget or whatever they believe Trump might do, which nobody knows at this point. I always laugh at all those forecasts. They've never been right. They've never been remotely close to right. They do not take into account how people behave. They have no effect that if you cut tax rates, people might work more or invest more. They've never been accurate forecasters in any direction. So I would not lose a lot of sleep about those. Deficit, though, reasonable to its upper edge. Go to the next, commercial and residential construction. This is as a percent of GDP on the right. That's the red line. And you can see over time, the combination of residential and commercial construction has been moving downward as services have grown, as tech has grown, as healthcare has grown as a part of the economy. And you can see in dollar outlays that it really plummeted. It's bounced back, still below its norm. There's a deficit to make up, but it is picking up. Let's look at construction. Go to the next chart. And this is an index I've created over the years that kind of is what is the cost of a hypothetical building to be built, commercial building to be built. There's so much labor, so much gypsum, so much land, so much. And it's theoretical, but it's an attempt to get a sense. The red is the long-term average. The real simply means adjusted for inflation. If it's rising, it's outstripping inflation. If it's falling, it's lagging inflation. You can see we're a bit above average. As the economy picked up and construction has picked up, particularly in certain markets, Seattle, New York, Houston, as those markets picked up, construction costs have moved up. It's not to the peak, but it's fairly high. It's not where it was in 2007, 2006, but it's fairly high. So cost pressures are out there for construction, as you well know. Go to the next chart. I think this is the most important chart to understand in terms of what's value exposure. My research shows that interest rates matter very little to cap rates. What really matters is this chart rising faster than GDP? And that is there a lot of money flowing? If there's a lot of money flowing to multifamily and commercial real estate, values rise. And if there's money contracting, values fall. You can see that there was a huge contraction, all concentrated in the commercial, not in the multifamily. There was a huge contraction that occurred from the peak of 2008 through basically 2011. You're in a capital-intensive business. If they take away your capital, it's a tough business. When capital comes back, values recover, capital chases, and there's quite a bit of capital out there. And I think this cycle continues. These cycles have run over long periods of time. There's a lot of excess capacity to lend at the banks. Go to the next, CMBS issuance versus a decade earlier. That is, almost what's coming due from a decade earlier versus what we issued. From 2000 to 2007, CMBS was a net provider of capital. Banks still are about 60% of all commercial real estate debt. CMBS is only around 12 to 13% total outstanding real estate debt. But in the first 7 years of the 2000s, it was a net provider. Since then, there's been more debt maturing than being refinanced. And in fact, you can see in 2016, there's going to be a shortfall of about 130 to 135 billion. It has not created a lot of opportunities because there's a lot of money waiting for anything that needs refinance. Banks are refinancing some of this. They're taking 5 to 7 year debt instead of 10-year debt. Some of it's floated and then swapped rather than fixed. Or some of it is equity that's been brought in. But this shortfall, this net withdrawal from CMBS has not been a catastrophe. By the way, 2017, my guess is you're going to see as much as 100 to 120 billion shortfall, and I don't think it's going to be a catastrophe for the same reason. Go to the next. Give you a sense of cap rates based on NCREIF data, based on transactions, actual sales that occur. And this is the spread over 10-year Treasury going back to 1983. Those of you old enough to remember, there was a negative spread in the early days because of all the tax gimmicks. And then since about 1990, we've had a positive spread of relative to 10-year Treasury in the 200 to 400 basis point level. Even though we have pretty easy money today, there's a lot of capital out there. You saw the red bars rising. The spread is still quite high. And it's because Treasury is artificially low. Cap rates have not moved to it. I think this is the opportunity, is that while cap rates may be low, the spread is high. Now, that's not true in New York. That's not true in D.C. That's not true in the Silicon Valley in San Francisco or West LA or Seattle. But in a lot of places, there's a really good spread. And while the low cap rate itself says, be careful, be careful, be careful, the spread says, this is a great opportunity. And in fact, it's a very good looking opportunity right now because spreads are there. You could also look at the spread compared to your borrowing rate, and the spread versus your borrowing rate is high. Again, not in New York, D.C., Seattle, etc. So I think the strategy to contemplate is, how do I take advantage of spread being wide, but not expose myself simply to cap rates are low? So yes, cap rates are low, but if I can get 150 to 200 spread over my borrowing costs, that's extremely good by historic standards. Lock it in 7 years or more, and make sure you can cover your interest. Move on. Let me take a real quick then look at values. The next chart is public real estate values. These are REIT values across all sectors, indexed, real, again, adjusting for inflation. And on these charts, you're going to see a marker for the high, a marker for the low, and the average. These are just to help your eye. Commercial real estate values are well above average, but they're not near the peaks that you had in 2007 when you adjust for inflation. So values are healthy, probably a bit above average, but not out of control at this point in the public markets. You go to the next chart, and it's the same thing done on private values. They basically are at new peaks after you adjust for inflation. Feeling a little pricey, and the discrepancy between the two charts is the discount to NAV that you see happening, where real estate is cheaper on Wall Street than it is on Main Street right now. That seems to be an arbitrage available. Go to the next, a different variation of this is RCA's look of retail real estate. So now all I'm going to do is go to different sectors of real estate and look at their values. Again, you'll see a high, low, and average. You can see that these are volatile because it depends on what gets transacted in any period of time. But values are above average in retail. I don't think they're really at a peak, but they're pretty healthy. They're above average. Moving up, you've got the next one as retail construction. Again, This is in dollars adjusted for inflation. This includes capital expenditures, TIs, as well as new construction. Again, a marker for high and low. And what you see is retail may have high values, but there's not much activity going on in construction. And in fact, most of the construction is repositioning, TIs, and CapEx. Do the same thing on the next chart. You'll see multifamily values, and you'll see that multifamily values adjusted for inflation are well above average, bouncing around maybe as much as 30–40% above average. So feel pricey. There's still good dynamics, however, on demand for multifamily for another few years until the millennials get a bit older. You go to the next chart and you see construction activity in dollars for multifamily adjusting for inflation is at a new high. Interestingly, units are only a bit above average. So you've got this situation where dollars are well above average at an all-time high, but units are only slightly above average, which says we're building a lot of high-end product in the multifamily sector. Everybody's piling into that type of product. Go to the next, same thing for office. You'll see the values a bit above average, maybe 5 to 15% above average, adjusting for inflation, nowhere near the peaks, improving, but taking a slow, steady climb. Go to the next chart. You'll see the same thing on the construction side for office. It's above average. It's probably about 25% above average. However, that follows a long period of way below average. And when you particularly remember, part of this is TIs and CapEx. One of the reasons it was so low in 2009, 10, 11, and 12 was deferred CapEx. So yes, there is new construction, but a lot of this construction here for office is deferred CapEx that is being done now. So in a way, it's probably closer to average. Do hotels, same exercise. You'll see hotel values probably peaked a year ago. Since then, they're still high, but they're probably off 10% or so. Above average, but still off from a peak of a year ago. Go to the next chart, hotel construction in real terms, adjusting for inflation, above average. By the way, above average by on the range of 80%. You got to kind of focus on that a moment. It is a big percentage above. Again, part of that was the deferred CapEx that occurred during the recession, but in the last year or two, there's been a pickup. Interestingly, the markets of Orlando and Vegas, which are huge hotel markets, show extremely good discipline. New York, Houston, a couple of DC, a couple other markets, not such great discipline. So it's very market specific. And then do the last sector, industrial. Again, you'll see industrial real estate values have basically risen to their peak. Not a lot of deferred cap expenditure here. Most of it is new construction. A lot of new construction underway. The sector's quite healthy. Construction, though, is on the range of 40% above normal. A lot of construction. Demand is good. If you go to the next chart, you'll see, though, that the value is good. If you go to the next chart, you'll see construction has followed those values, and as values have risen to new peaks, construction's at new peaks. When you start getting construction at new peaks for very long, values do not tend to stay at peak very long. Now, this varies across markets. It's not every market has high construction, but it's an active sector. And Bruce, I think what I'll end with is my speculation on the impacts of the election. The last chart, and I'll end there. We don't really have a Republican president. We have an independent. We have an independent who was a business person who spent their time, full-time, thinking about business and had views about politics, like most of us. suddenly that independent who has some views more consistent with Democrats, some views more with Republicans, and a lot of them not thought through, is the president. You clearly have a Republican Congress, both in the House and the Senate. The Republican House and Senate especially, and I think the president, are obsessed with changing Obamacare. It's not clear exactly how they change it. Obamacare is very complicated, and therefore deconstructing it will be complicated because it's a sector that's 17% of the economy, so you have to deconstruct it with some care. You can't just go in and blow it up. You have to deconstruct it with some care. It runs the risk that they get bogged down in the detail, and it just bogs Congress down for the next 2 years until the by-elections. That's the thing to watch for, is that there'll be tweaks to it, but it's going to be complex to really unwire it and rewire it to a new form. Trade agreements, there'll be a lot of tweaking going on. Things that are presidential will be dealt with, probably raising tariffs here and there, probably putting in some quotas here and there. I'm not a fan of that, but I think that'll happen. But overarching trade bills, the one that the Trans-Pacific was not only multi-party, it was 3,000 pages. Think of how complex the negotiations were to get your 50-page purchase and sale agreement. Now imagine a multi-party 3,000-page agreement. That takes years and years. Usually the president that signs is not even the president that started the negotiations. So there'll be a lot of talk, and I think there'll be a lot of victories declared on trade, but real change is going to come quite slowly. Personal income tax. My guess is what will happen is they'll raise by 100 basis points or so the top marginal tax rate, so they can say that they're not selling out to the wealthy, to the high income, by raising it by some nominal amount, and they'll reduce all the other marginal tax brackets. Since we have the tax system where you pay the tax rate on your first money at the lowest tax rate and upward then, it means that even high-income people will have a lower tax bill, even though the marginal tax rate will be higher, because they're going to pay lower taxes on their first income, if you will. But I think that will stimulate a bit of activity of people wanting to work a bit more, come off the bench. The research would show that it could bring as many as 1 million to 3 million additional workers in if they got to keep more money. In addition, I think you'll see major corporate tax rate reduction. In the last 20 years, we went from the lowest tax rate among developed countries to one of the highest without changing our corporate tax rate. I think you'll see it slash to 15% or so, and that will have a notable impact. It will bring a lot of that money back that's overseas. A lot of that money overseas is trapped in that it's in places where you don't want to invest. You can generate profits, but you don't want to invest. If they can bring it back home, they can allocate it where they want, or do share buybacks or increase dividends. I think what will happen also is that a capital gains tax probably will stay about the same, maybe a very minor reduction. The estate tax probably will get dealt with by lowering the rate a little, but primarily by pushing up the exemption from any estate tax. Since Trump won, I don't think the real estate sector is exposed to laser-specific reforms related to it. And I think what you'll see across the board is a greater, what I would call, belief in markets. I'm not saying laissez-faire, just a greater belief in markets across the board. You'll see fewer regulations. You'll see some of them repealed. You'll see less aggressive. You won't get something like the Department of Labor did a few years ago, saying Boeing was violating labor law by opening facilities in South Carolina because they were hiring union labor in Seattle. You'll get a creeping deregulation, I think, is what you'll see. I said the foreign cash. You'll get somebody who attended a university other than MIT as a Fed chairman. Most of the central bankers around the world are all trained at MIT at a certain time, and they have a certain group think. There are plenty of people, I'm one of them, but John Taylor and John Cochran and many others who have been trained at other places and see this argument I said, which is low interest rates kill the economy, not stimulate it. And the last is I don't think Mexico will build a wall all the way across and pay for it, though I do believe there'll be enhanced security. There'll be illegal aliens sent back. I hope that we don't send back these children that are here alone. Anybody who thinks we should send back illegal children that are here alone, I encourage you to get a video called Nikki's Family about a gentleman from England who saved at the beginning of World War I and a number of children from the Czech Republic by bringing in orphans out of a place that was about to explode in war and the good that came from those children over their lifetime. And with that, Bruce, I'll end.
Okay, great. Thank you, Peter. Really appreciate all of the insights. Taking a look through the questions that have come through from the participants, and you know, it's something that's been on my mind a lot too. People seem to have interest rates on the brain. Most of the questions that have come through have that as a recurring theme. One of the participants is curious in particular to know, you know, we've talked about the interest rates being artificially low for such an extended period of time, but wasn't one of the reasons for that, and perhaps a continued benefit of that, the propping up of what was a relatively weak housing market?
It did not prop up a housing market. What it did was, if you had the money for a down payment, it said you could borrow cheap. But if you didn't have a down payment, it effectively put 100% tax on the primary source of getting down payments. What do I mean by that? A primary source of getting down payments are the 6 months to 2 year CDs that both individuals and their parents and grandparents invest in that generate income that allow people to do down payments. And those interest rates went from something that should be around 3% today to 3.5% to 0. And that was done by Fed mandate. It wasn't done by markets, it was done by Fed mandate. If you said interest rates should be 3% and I'm getting 0, I'm not quite getting 0, I'm getting a little more on my 6 month CD than 0, let's just call it 0, that's 100% tax that the Fed imposed on a primary source of down payments. If I told you you imposed 100% tax on something, you're going to see a lot less of it. And what the Fed did was effectively impose a 100% tax on short-term, say 2 years and under, low-risk investments. And those low-risk investments of short maturity are a major source of down payment, and they imposed 100% tax on it. And imposing 100% tax on it does not prop up the housing market, quite the opposite. It crushed the housing market.
Okay, well, the prospect of interest rates eventually rising makes people think about and fear inflation. What are your thoughts on inflation kicking back in as interest rates come back up?
Historically, interest rates go above their natural state, if you will, when inflation is well above its natural state. We don't have that right now. What we have are interest rates that on the short end are 300 basis points below where they would be by natural forces, all created by government policy, the Fed, and long rates about 200 basis points below where they should be, to a large extent created by government policy at the Fed, not 100%, to a large extent. We know we can have healthy economies at interest rates of 3% on the short end and 4 and 4.5% on the long end. We know that. We've done it most of history. And in fact, what we know is that when you see economies that have kept interest rates really low artificially for prolonged periods of time, like Japan, you do not get healthy growth. Low interest rates do not create growth. They create cash holdings, which do not create growth. They create lack of down payments, which does not create growth. So I think that what will happen and what should happen is we'll get more growth with uncertainty because we've had the artificial rates for so long. But remember, we used to, and see, most of the people aren't old enough to remember, in the 1970s, the government artificially put oil prices in the United States way below where the market was going to put them. And what you had was all kinds of shortages, huge lines for cars, dragged the economy down. The artificially low oil price and gasoline prices dragged the economy down. Yes, everybody wanted it at that price. Nobody would provide it. And then in 81, we deregulated, oil price shot up, and the economy improved. The economy did not get worse. The economy improved as the oil prices went towards normal. People could drive normal. People could do things normal. Companies could get resources normal. Higher does not mean reduced growth. Higher moving to market means better growth. And I just think this little episode of oil prices when we deregulated in the early 80s is a very vivid kind of example of when you get rid of artificially low, you get more economic activity. That's very different than when you create artificially high prices, say by the OPEC cartel pushing them above where they naturally would be. So there's a place where markets more or less are constantly trying to push. I don't know where the interest rate should be. I know by historic standards you'd say 3.5% on the short and 4.5% on the long. I know it's not by market where the short is today and where the long is today. It's north of that. And as it moves up, I think you'll get more activity, not less.
Well, one of my observations, and that of many of the participants who wrote in, is that when we take a look, just sort of take a big step back from a lot of those slides on the values of the various commercial sectors. I mean, we're a boat bobbing up and down on the ocean there, and we're about 10 years removed from the last peak, and so a lot of the folks who are writing about this on the line are concerned that it's kind of time here for another correction. What are your thoughts in terms of where do we stand in terms of the property cycle clock, and if we are going to have a correction imminently, what is the cause potentially going to be this time? Because it's typically something different each time.
Well, the underlying cause of the value drop tends to be either excess supply or a shortfall in demand because the economy crashes, or both. That is, you get both a lot of supply coming along and the economy going down. That pushes NOI down and that reduces value. But the bigger cause of the drops in value are that debt capital withdraws. And when debt capital withdraws, the person coming to refinance goes from a 70-30 debt equity stack to having to get like a 30-70 debt equity stack. And that changes the cost of capital quickly. I say that if you're in a labor-intensive business and labor goes on strike, you're going to have a hard time making money. If you're in a capital-intensive business and capital goes on strike, you're going to have a hard time making money, but eventually the strike ends and value rebound. The triggers, though, tend to be this. Lenders, particularly banks, need to retrench their balance sheet and incomes down. I don't see the incomes down yet for another 2-3 years for the reasons I said, and I don't see the capital part down for the next couple of years. In terms of, are things peaky? I feel pretty good about retail in general, or good retail in general, because there's not much construction. There's pretty good demand. Values are above, but supply and demand, it still seems pretty good, a lot of capital. As you go to some of the other sectors, and I've been, look, who am I to second guess somebody's investment decision, but buying at a 2 cap, a mark-to-market income stream, or a 2.5 cap, like a New York apartment, it's just hard for me to understand. So I think that values are on the upper end of risk. I don't think they're in a screaming zone. And that's what I meant, Bruce, when I was saying low cap rates are sending caution signals, but if you can find big spread and lock it in, that looks like a bargain. And there are certainly lots of places still where you can find spread. Not everywhere. You can still find decent spread in your borrowing, over your borrowing costs, over your long-term borrowing costs in a lot of places. Not every place, but a lot of them. I think in those markets, I still feel pretty comfortable. If I've got 0 to negative spreads relative to my borrowing costs, it's harder on a mark-to-market asset. Now, when you look at office, and it's harder on office because it's lumpy, because you have rent rollovers from 10 years ago and so forth. That's why I'm taking apartments as a benchmark, because you get mark-to-market rents. So there are places I think are feeling peaky. There are other places, though, that I think there's still good spread investing. You put on as much debt as you can carry and still meet kind of historic downturns without defaulting. So you borrow not more than this property or this type of property could sustain if there is a drop in income, because sometimes there is going to be a drop in income. And you want to be able to survive that. Think of the last crash, Bruce. It was bad in terms of NOI. It was bad in terms of value. And here we are 7-8 years later, and values are back at new peaks, NOIs are back at new peaks, basically even adjusting for inflation. So it says, if I can buy with spread, I'm in good shape. I think I'm in good shape.
Great. Thanks very much, Peter. So unfortunately, we're not going to have time to answer all of the other questions that have come in over the course of the call. I do want to make folks aware that this presentation is very much a digest of what is presented in a much deeper analysis in the Linneman letter, which is a quarterly subscription. And if folks on the call are not current subscribers would like more information, please do reach out to Doug@LinnemanAssociates.com. And there was just one housekeeping note that came through. Unfortunately, I think the audio broke up a little bit when you were making your point about potential relocation of illegal immigrant youth in the U.S., and I think it's fair to say that you were stating that it would be a big mistake. Is that?
Just to repeat, it would be a huge mistake. Put aside criminals. I'm not talking about criminals. That's a whole different matter. And you can even have an interesting discussion about adults who are here illegally. But these children who have come or are here as children alone, so to speak, to send them back just seems cruel and unusual. And I said there's a brilliant DVD about a man who did an amazing thing just on the eve of World War II in the Czech Republic, getting some 700 children out, and you come back years later and you see the good children have wrought over their generations. And the video's called, I have nothing to do with it, I was just a viewer, called Nikki's Family. And it's very, I think, it's should be seen by anybody who thinks we should deport these here alone children.
Okay, great. Well, thank you everybody for joining. This is a quarterly webinar series, so please do check back with us. We'll announce the next date about a month ahead of time. And again, please check out the LinnemanAssociates.com website for more information, and that for real estate financial modeling as well. And have a safe and happy holiday season to everybody. Thank you.
Thank you.